Order, order. Welcome to the Treasury Select Committee on Tuesday, the 11th of March 2025. Today we have two witnesses in front of us in two sessions. First, I'm delighted to welcome Andrea, who is the appointed member, or being proposed as the appointed member for the Prudential Regulation Committee at the Bank of England, and is the governor's appointment at the Bank of England. And we're here to talk to Mr. Enria about his background and his suitability for this post. I should stress we have no power of veto, but there have occasionally in history been witnesses who've come a cropper because of the answers they give to this committee, which I'm sure Mr. Enria is aware of. Can I first of all just ask you a little bit about the process, Mr. Enria, for this is a new committee and the first time this particular committee has held one of these sessions, and we sent you a questionnaire about your background. Can I just ask, when you got that questionnaire, did you fill it out yourself?
Yes, of course.
And did you share that questionnaire with anyone else when you sent it back to us, other than this committee?
Well, I sent it through the Parliamentary Affairs Office of the Bank of England.
Okay, that's fine. Thank you very much indeed. I'm going to throw straight then to Dame Harriet Baldwin, MP.
Thank you very much, Chair, and good morning, Mr. Enria. You've been asked to take on this role by the Governor, and your background is primarily with the European Central Bank. And I just wondered if you could share with the committee what you think that the European Central Bank does better than the Bank of England, and what you think the Bank of England does better than the European Central Bank.
First of all, let me say that the Bank of England and the European Central Bank cooperate very nicely. I think this is something which is not very well known. It's something that goes on in confidential channels, but I think the collaboration on supervisory issues between the ECB and the PRA and the Fed, for that matter, in the tripartite agreements that we have, is one of the bulwark of global financial stability. Is very important, and that's also why I was so excited about taking up this role. In terms of differences, and what I appreciate very much at the Bank of England PRA approach to supervision is the strong reliance on supervisory judgment. At the European level, there is a little bit more of a rules-based approach, which leads sometimes to supervisory tick-the-box type of practices. I made a lot of effort when I was at the ECB to try to push the practices of the ECB towards more judgment-driven assessments in line with what is done here at the Bank of England. And I think that's an element of strength. Also, the interaction with the firms is more based on dialogue, while on the European side, maybe sometimes it's more adversarial in terms of relationships. And I would say also important elements of strength here are the focus on, of course, on market risk, on interaction between banks and, for instance, other intermediaries, which is particularly topical, I would say, at this point. The recent system-wide stress exercise that the Bank of England conducted to understand the contagion between different sectors, I think, is a world-leading example. On the ECB side, what I'm very fond of, and I've been trying to convince my colleagues at the Bank of England to consider it more, is the reliance on on-site supervision. So having an independent team of supervisors that go on site in the bank sometimes and assesses also valuations. I think that's particularly useful as an instrument when you are, like now, at the stage of the credit cycle when maybe banks might be underestimating credit risk. And so going into the details of valuations could be particularly important. Another area maybe is as I mentioned also in my questionnaire, is the investments in subtech. So I think that the ECB, for instance, is investing a lot in new technologies, also in generative AI, using supervision, and I think that the Bank of England could benefit from moving in the same direction.
So will that be one of your priorities then, to take some of the things you think that the European Central Bank is doing better than the Bank of England and argue for a change there?
No, not really. Of course, I come with my baggage of experience and with my views, and that's what I plan to bring to the internal debate in the Bank of England.
Thank you, Chair.
Thank you very much, Dame Harriet. Bobby Dean, MP.
Thank you. Good morning. You just said that we're at that stage in a cycle where banks may be underestimating credit risk. But the Chancellor recently in a Mansion House speech talked about how the regulatory changes since the crash may have gone too far, that maybe we are in a system which sought to eliminate risk-taking. So do you agree with the Chancellor?
Well, let's say, one point in which I would say I agree is that the repair after the regulatory reforms and the repair done after the global financial crisis has delivered a very complex regulatory environment. This is not an issue only for the firms, it's an issue also for the supervisors, because running this machine is sometimes very, very complicated. So I can see arguments and room for having some simplification of requirements, having some attention on compliance costs that they are causing to firms. I would not be supportive if the Chancellor were to mean that we need to water down the requirements with a view to support growth. I mean, my experience has been that having strong prudential requirements in line with the international standards is fundamental to support growth, actually. I mean, if you compare what happened in the US in the last 10 years, you have had an extraordinary performance in terms of growth, and you have had capital requirements which have been gold-plated with additional layers on top of the international standards. In the European Union, there have been deviations from the international standards, watering down requirements in certain areas to support lending to certain counterparts, and the growth performance has not been as strong. So I think that actually strong capital requirements are supportive of growth, in my view.
I mean, the thrust behind the Chancellor's comments is because she wants to generate growth through regulatory means, and you've said that actually you'd only really be in favour of sort of simplification of rules. Do you think that could be growth enhancing, this kind of simplification that you're talking about?
I mean, to some extent, of course, if you... there are several areas in which regulation could help also pursuing, increased lending in certain areas. I think we are facing probably globally challenges in terms of financing, digital transformation, green transformation. So there are huge financing needs. So you could ask yourself, how can regulation, help that? I think the first way in which it could help is indeed by providing a robust prudential backdrop to financial activity and lending. I also think that you should be careful in the way in which you tailor the rules also to the business models and complexity of different firms, the impact these have on competition, on entering the market, having, of course, a vital, vibrant market with new entrants, with good competition, I think is something that can be very effective in supporting growth. And the other key point is, how do you support innovation in the economy around you? And that's something that, of course, is a particular area of attention, I think.
Mr. John Glenn, MP.
Can I just ask you specifically, if we drill into two specific examples, the Solvency II changes, which were consequential of the opportunities that came post-Brexit, where there was a really deep fundamental dispute between the PRA judgment on what could change with the matching adjustment and what insurance industry would say was totally acceptable, in a world where new investments, new opportunities to invest gave a different profile of return to the traditional models that existed within the PRA. Now, that and the second example around smaller banks. So about 10 years ago, we had the smaller banks unit, lots of small banks being set up. But I think we could probably say they haven't really led to a fundamental shift in competition. Now, those market actors would say that the PRA is too slow to adapt to the changing profiles and investment returns in the first example, or the relative systemic risks that don't occur with smaller banks, therefore impeding competition. How do you see your role as sort of facilitating the optimization of that sort of competitive environment for growth in those sectors?
Mr. Enria.
Well, it's a difficult question, of course. Again, I think that the PRA is a prudential authority. I think that it would be, I personally would view as inappropriate for a prudential authority to think of itself as a sort of social planner, that we understand better than others which sectors are more dynamic, where investments should go, how should you model risks. I mean, I think that that's not the role that I think...
Your judgments are instrumental in framing the operating environment for these companies to be successful.
I think that, again, I mean, the framework, for instance, I speak more of banking because that's the area I know more, and I know I have some catch-up to do on the insurance side. In banking, I mean, you let the banks estimate themselves, especially the more sophisticated banks, estimate themselves the risks and the capital that is needed to back certain exposures. What we do is to challenge the banks, is to, put up a reasonable challenge. And when you see that some banks, maybe compared to their peers, are being less accurate in measuring risks and are maybe taking too much of it or are too, so we try to do a sort of, I think, very healthy role of challenging the industry. In terms of small versus large banks, again, it's another difficult challenge, which I've seen also from my lens in the European Union. In the European Union, you have, for instance, a tradition in certain countries of very privileged regimes for small savings or cooperative banks, which have been also, to some extent, a barrier to entry, to other firms in individual markets, and one of the shortcomings in the functioning of the single market. So you always need to be very careful. In my view, it is what the PRA is doing, for instance, with the strong and simple framework, is something very reasonable, because it keeps the safety, let's say, and the comparability of what is applied to small and large banks in a reasonable framework, but at the same time it reduces the compliance cost for smaller firms, enabling them to maybe overcome what is undoubtedly a fixed cost that can damage smaller firms.
Thank you.
Thank you very much. Mr. Lee? Oh, Mr. Christopher.
Thank you. I thought it was very interesting your point that the US has had higher economic growth than the UK and Europe with higher capital requirements. And given your point around simplifying regulation, how realistic is it really to simplify regulation given that some financial products are so incredibly complex? And obviously one of the issues during the financial crash was you had these incredibly complex mortgage-backed securities and everything else that no one, including the bankers themselves, actually understood.
Well, you raise a very, very important point. There are areas in which simplification can be pursued relatively easily. I mean, the strong and simple is one of those examples. There are other areas in which I personally think would be easy to pursue it. For instance, we have an incredible complexity in the type of instruments that are recognized as capital, as loss absorbing. We have different layers, rules which have been superimposed on previous ones without maybe considering duplications or conflicts. But when you start engaging with the industry on these simplifications, sometimes you find that they are now not so convinced that this would be a positive way forward, because sometimes change is costly, is expensive for firms. So I think that we should pursue possible areas for simplification in different areas. But you are right that the complexity sometimes emerges from the attempt of regulators to go with the grain of the market, so to reflect good industry practices, to go through consultations and incorporate comments from the industry. When I started many years ago as a regulator, I was in a much simpler regulatory environment in which there were prohibitions and segmentations. That was a much simpler environment, but definitely less vibrant.
And does this complexity extend, in your view, to whether actually some of this financial services growth is actually real, or whether it is actually just credit expansion? And I'm thinking about the whole debate prior to 2008 about to what extent the financial services growth was a social good. and how does that inform your view?
It is undoubted. I have no doubts that there has been an expansion in the financial sector, which has sometimes not created, real growth in the real economy. There has been an excess of complexity. That was one of the reasons in the build-up to the global financial crisis, for sure. And I see some of these complexities starting again right now, and there are some question marks there. Now, again, I think that the role of a supervisor is not to shape the world or to, prohibit products or constrain financial innovation. Is just to, put the right safeguards, the right limits in terms of risk taking.
Thank you very much, Mr. Coughlin. John Glenn, MP.
Yes, can I go back to this issue of the objectives of the secondary objectives of the PRA and how you view them? Because you've got competition on the one hand, and then you've got international competitiveness and growth on the other. Could you start by explaining, so that members of the public that are watching can understand how you view the trade-offs and the way that you discharge your responsibilities on those, and distinguish between them?
I do not see huge trade-offs. I mean, the idea that I tend to fight the idea that the objective of safety and soundness is to be pursued to the cost of lower competition. Or it was something that was very strong, again, a long time ago when I started doing supervision, that you have to constrain competition to beef up the profits of the banks and ensure their stability. Now, I don't want to bore you, but when I started, there was, in the Bank of Italy, there was a need for an authorization, a sort of plan to open branches in individual provinces, because you think that if you had too many banks in an area, this would have been destructive of value, and the banks would not have been profitable enough. Now, we are far away from that model. We know that competition supports stability, and stability is important to support competition. So I don't see clashes, and I don't see clashes also between the primary objective of safety and soundness and the growth objective. The way in which the PRA is doing it, I find it very sensible. No? So there is, I also find sensible the way in which the secondary objective is framed. I mean, first of all, because there is a reference to the international standards. Something that I would view very negatively is if, to attract business, so to enhance competitiveness, you were to enter into a race to the bottom in terms of prudential standards. I think this would not be supportive of long-term objectives, and would also be not compatible with the international financial center status of London and of the UK. And I also think that it is important to have a focus on long-term growth, not on short-term growth, because we know that there could be, if you tighten the standards, for instance, you can have a short-term adverse impact on growth. But what matters is to understand what is the long-term impact. And I think it has been proven by many studies done at the Basel Committee, for instance, that usually when you reach a satisfactory level of capital, which is where I think we are now in the UK and globally, then let's say the cost of the capital requirements becomes much less impactful on growth. So you can pursue also growth objective without entering into any trade-off.
Thank you. And I think you've mentioned strong and simple proactively a number of times as a sort of regime for smaller deposit taking banks. But I think there's this sense that we have from the government and from some who offer commentary on these matters that there's an expectation that, as my colleagues have alluded to as well, that there is a suboptimal level of regulatory oversight. And if we look at specifically about effective domestic competition in the banking sector, back to the point I made slightly earlier. We've got, 4 or so dominant banks. We've facilitated new entrants. They have the strong and simple regime, which is less onerous because they're not systemically important. Yet we don't have the sort of competition domestically, arguably, that many people would expect to see. How do you view that assertion? And what role or evolution in the role of the PRA do you think could help to change things in that regard?
I might not be knowledgeable enough about the dynamics within the UK banking sector, to be honest with you. My impression, looking from a distance, honestly, I don't see this issue as in comparison to other financial centers. I mean, there have been, I understand, around 80 new banks that have been granted the licenses, the 2013, 2014 cutoff date. I've seen a number of neobanks, also these, tech banks, mainly app-based, that have developed their business. It's an open financial center, so there has been entry from banks in other jurisdictions. I don't know. I don't see, but maybe I missed the underlying analysis, any major issue to be fixed. But of course, if there is an issue to be fixed, the strong and simple, I wouldn't argue that this is the magic wand that will make any issue go away, but still is a new attempt to tackle this issue. I understand it's not yet implemented, so basically I think that could be providing even more room for enhancing competition in the country.
Thank you for your answers.
Mr. John Grady, MP.
Thank you. That's all very interesting, Mr. Enria. Just one macro question about the role of a regulator in financial services. And this is, all regulators fall into the fallacy sometimes of fighting the last battle, be it the tulip boom, the railway boom, property in the 70s, or the last financial crisis. Do you feel that the regulatory community understands the current and future risks in the system as well as they should do? Or are they focused on the preceding risks?
It's a fair question, and sometimes it is true that I've seen these dynamics, that you have problems materializing in the industry, and the debate immediately goes into how do we fix it via new regulations. I mean, the key lessons I learned through my career is that there is quite a long way you could go with effective supervision. And by effective supervision, I mean particularly also the engagement in the definition of the supervisory priorities with the analysis, with the macro-prudential analysis, with the analysis of risks going forward. When I was at the ECB, I tried to develop a framework in which every year you had a sort of horizon scanning of the risks that were coming, that was enabling the ECB to define the priorities for supervisors for the next year. So supervisors were then to allocate their time, both of course to the specific issues that were relevant for their individual firms, but also to some horizontal reviews that were trying to cover the risks that were identified by our board as important in a forward-looking manner. I cannot say that this is working perfectly, but I think that's important to have a risk-based supervisor.
And one final question from me, if I may, Dame Meg. With all your experience, what are the two things that are keeping you awake at night?
You first. Nothing.
Well, I think that the key issue that we have, the nut we have not cracked yet, is risk culture at firms. I mean, that's if you look at the PRA, the Fed, the ECB, and the amount of findings and shortcomings that they find in firms in their supervisory processes, most of them are in internal governance, internal controls, and board effectiveness in actually focusing the attention of the senior management on risks. And this generally is built in the risk culture of the firm. And the risk culture is not something which you can change as a supervisor by, maneuvering your usual tools with capital requirements or with sanctions. No, so the board needs to own it. So how to make the board change views and take ownership of these issues is a real challenge for supervisors. When I was at the ECB, we also used a team of organizational psychologists at the Dutch Central Bank that went on site witnessing the dynamics within the firm and then reported to the board of the firm, trying to put them in front of a mirror and show them where their weaknesses. In some cases, this approach worked, but that's a difficult nut to crack for us as supervisors.
Thank you very much for that. You, MP.
Thank you, Chair. Mr. Enria, in terms of future risks, in your questionnaire you write that there is still some way to go to set clear supervisory expectations for the management of climate risk. Could you say a little bit about where you think the biggest gaps are when it comes to the management of climate risk and what the PRA should be doing about this?
I think the PRA has done already a good job in terms of setting up high-level expectations for the firms. The experience in general that I've seen is that it is very difficult for firms sometimes to, step up their ability to measure and manage climate risk. The argument they usually put forward is that they do not have enough information to manage that risk because they do not have, the customers have not provided them with the right information. And my point as a supervisor needs to be, if there is a risk and you tell me that you don't have the information to manage it, then we have a problem. You need to step up your ability. So I think that as supervisors, we need to identify clearly, firm by firm, what they need to do to fix this knowledge gap that they have. Again, in terms of setting a risk appetite framework for climate risk, in terms of having a stress testing capabilities on climate risk, in terms of having also in the longer term a plan, a transition plan that is effective. And again, I know that sometimes the firms tell me, the political environment is changing, there are different jurisdictions pushing us in different directions. I think that will be the new normal. They will have to navigate probably different environments going forward on climate risk. So it is important that they are well equipped to do that.
Thank you. Thank you, Chair.
Thank you very much. Rachel Blake, MP. Sorry.
I want to pick up on that climate point, if it's all right, Mr. Enria. In your answer to the questionnaire, you focus a lot on the transition risk of net zero and less so on the physical risk, that is, of climate-related events. So what physical risks do you see as being particularly relevant to the
the last months even have shown us plenty of physical risk materializing with the wildfires in California. I think there are quite interesting maps which are provided also by dedicated organizations, NGOs, that identify the areas that are more subject to, wildfires risk, flood risks, and the like. So I think that this risk is already materializing. It's particularly relevant, of course, for the insurance industry, but also for the banks when they take long-term exposures into certain segments. Course needs to be understood and factored into the risk management process of the banks.
Yeah, and then thinking further on the PRA and its own supervisory kind of expectations, if you like, onto firms, how do you think the PRA should be updating its supervisory expectations relative to those physical risks of climate-related events?
I think the key point is measurement. Understanding, being able to measure if you don't know, for instance, if you don't factor into your scoring process when you vet a potential customers the risk that the collateral you're taking could be strongly devalued because of floods, because it is not insured, because of wildfire risk, then you are taking additional risk. So I think the valuation of of collateral and taking into account is a key element.
Brilliant. Thank you.
Thank you very much. Rachel Blake MP.
Thank you, Chair. Mr. Enria, in your questionnaire, you wrote that if we look back to the major episodes of failures at financial firms, we can always identify a root cause in poor culture, especially risk culture and ineffective governance. And at the same time, you said that culture is a difficult area for supervisors to intervene. It is not easy to show evidence of an inadequate risk culture, as most frequently poor behaviour and decision-making are driven by internal, non-codified norms, behaviours and attitudes. What can you bring to the committee, and what focus will you bring on culture in your new role?
Again, I'm very, very keen to engage into this conversation. I cannot say that I have the solution to bring to the PRA on this topic. What I can say is that there are already a number of tools which are deployed by the Bank of England. I'm already at the Bank of England now as a senior advisor, so sometimes the Bank of England deploys board effectiveness reviews, which in my view are a very interesting tool, because you observe and engage with the board and the committees of the board and individual members, trying to understand, how the dynamics develop. What I say in my reply to the questionnaire is that sometimes it's difficult to go deeper. So the example I was mentioning in my answer to Mr. Grady is that sometimes it's interesting to deploy other tools, or what this specialized team at the Dutch Central Bank does, for instance, is to do also interviews and questionnaires with middle management and staff, actually more broadly, trying to get feedback from the people working for the firms. There are also interesting tools which are being developed. I know of artificial intelligence mechanisms based on the use of metadata. So they see, for instance, how the communication between the risk management and the front office goes in terms of who's activating the mails, how long the others take to respond. They don't look at the content of the mails, because that would be, of course, in violation of privacy requirements, but they look at the dynamics of communication inside the firms to understand how relevant certain functions are, the status of different functions internally, and this can help you understand better how the firm inner working can affect risk-taking. So these type of tools, I think we should be all trying to understand how they function and whether they could bring value added to supervisory work.
Given the significance that you've apportioned this within your questionnaire, are you concerned about a slow rate of progress to use these tools and the level of visibility of this type of risk?
Well, I mean, we shouldn't think that this is the golden tool that will give us all the answers. I mean, I'm saying that this is such a difficult area for a supervisor to engage in that we should be open-minded and try to test different tools and see what works best to try to push the progress that I think is needed in this area.
But are you surprised at the slow progress with this, given the significance of the risk?
I wouldn't like to convey to you the idea that there is a widespread problem affecting all the firms. What I'm saying is that sometimes, there are firms which are shortcomings in this area. The problem is remediation. It's difficult to, if I have a problem in a credit portfolio, I tell the firms, I use the indicators, I have the evidence, I tell the firm what I want to see within the next 6 months, and I check the progress. When I see a problem in governance, it's much more difficult. Sometimes the board itself doesn't recognize the problem, and the discussion can become very adversarial and difficult. I don't have clear metrics to push the progress, and the tools are not simple to maneuver. So that's why I think that we need to experiment additional and maybe new tools to deal with this topic.
Thank you. In terms of the political environment in the United States, how worried are you about a change in risk culture within US firms and the impact that this could have on UK firms?
As I said before, the US in the banking area, the US have adopted very strict requirements compared to other jurisdictions, including the UK and the European Union. So, I mean, I think that they have quite a long way to, to change the rules before this starts becoming really a concern in terms of comparison of standards. The area, so of course it's important that the US show their commitment to be respectful of international rules that we agreed together at the Basel Committee table. I'm sure that the US agencies are very much into that camp, and that would be important because throughout my career, I've always played a lot of emphasis on the need of having robust international standards that are abided by all jurisdictions globally, and I'm confident that this will happen also in the US, where banks are not required a lot of adjustment to be in line with the international standards. Maybe the areas in which I think we should look with some interest, but also personally with some concerns to the US, is the regulatory developments in the area of crypto assets and stable coins. I think that's an area where we need to see how this affects also, not only consumer protection globally, but also potential, engagement of financial firms globally with these type of products. And major differences in regulatory approaches across the globe would, of course, require important discussions at the global tables, like the Basel Committee, for instance.
Thank you very much, Ms. Baker. John Glenn, MP.
Can I just move you on to the Basel III implementation and the consistency point? Often representatives of banks used to say to me, well, we're concerned that ECB or US are going to take a different line or come up with a different interpretation. Now, in your answer, I think answer 7 in your written evidence, you talk about the importance of the consistency, but it's also important, surely, that we customise and align as much as we can within the broad adherence to global standards, the right solutions in the UK. Can you just explain to us how you see the parallel and sort of alignment to international norms, but also the optimization for UK institutions in a world where the US's new president and new leadership is inclined to make executive orders which somehow muddy the waters a bit about the independence of regulators? How do we remain competitive in the UK in this context?
Look, I have to be candid with you. I have a rather extreme position on this point. So my view is, which I know is a bit utopian, is that in an ideal world, I would like to see for prudential standards for banks the same approach, for instance, the European Union adopts for accounting standards, so that basically you have an automatic transposition into legislation, so you don't have room to change. The international standards are designed for international banks. I've been sitting for years and years at the Basel Committee table where all these specificities of the US markets, the German market, the UK market are brought to the table, heavily considered and factored into the international standards. And these concern international firms. Now, I can't remember the figure of banks which are involved, but if I'm not wrong, it's around 140 firms or something like that. So we are talking about a relatively small sample of banks. So I would really like that for these firms, we have a truly homogeneous environment. Now, that's not a reality. I understand that each jurisdiction is in some way or another deviating from the international standards. I understand that. I can live with that. In some cases, this goes through legislative processes. So, as a regulator, I have to, of course, to apply what Parliament decides.
In reality, Parliament doesn't really decide because we do our best, but we are not somebody with all your experience. What I'm trying to get at is that your commitment to those global standards, which I respect, and I'm sure the committee broadly would agree with, have got to sit alongside the opportunity within the optimization parameters that exist in other jurisdictions to do it as best as possible in the UK for our sector in a globally competitive. So how can we be sure that you will optimize the way that plays out in the UK for our sector? Because frankly, the US and ECB and others look at slight deviations to respect the different culture and heritage of their banking sectors.
For me, the real argument is evidence. I would like the industry to bring evidence in a consultation process that shows me that the calibration of the international standard is not appropriately capturing the risk of that line of business. If this evidence is there, I mean, I'm a technical authority. I mean, evidence matters for me. What I've seen so far, honestly, also on the European side, is that sometimes this evidence is not there. I mean, even in certain areas. Yeah.
As a minister to them, and because you can't do much from just instinct.
Exactly.
Yeah. Well, thank you very much indeed for a very interesting session. Wish we had longer. Can I just ask finally? You've obviously got your footprint in Italy. Are you planning to live in the UK?
Yes.
So you'll be
living in the UK already.
You live in the UK. Fine, fantastic. Thank you very much indeed. Thank you very much indeed. We'll be considering the appointment and our comments back to the bank. And in a private meeting after our next session. Thank you very much indeed.
Thank you.
Order. Welcome back to the Treasury Select Committee on Tuesday, the 11th of March. And we're continuing our confirmatory hearings into newly recommended members of the Prudential Regulation Committee. So I'm delighted to welcome David Soanes, who is appointed as an external member. So his appointment's 3 years. And we're very keen to hear from you today. So I should just stress, of course, we don't have a power of veto over the appointment, but nevertheless, we're keen to hear what you'd like to say in public. So first of all, can I ask, you had the questionnaire. Did you fill it in yourself?
I did fill in the questionnaire.
Did you share that with anyone?
I shared it with the parliamentary affairs people at the bank. Yeah.
And did anything change after you shared it with them?
There was a few nudges, but it's virtually all my own work.
Okay. Well, perhaps we'll pick up on what nudges. Were there any nudges of significance?
They pointed me in the direction of information I hadn't really picked up on the AI response of the bank and the PRA, and so I expanded my answer to that AI section.
Okay. Thank you very much indeed for your candour. Dame Harriet Baldwin.
Thank you, Chair. Mr. Soanes, you're very much a poacher turned gamekeeper, aren't you? And I just wanted to drill into your conflict of interest, because you obviously still do retain some UBS exposure. And I'm not going to pry and ask you how much that is or anything like that. I understand these things are locked up for a period of time. But can you share with the committee what percentage of your overall net worth you feel is now tied up with the health of UBS?
Well, thank you for the question. Currently, it might be 10%, but by the time I start on the 20th of March, I expect none of that will be equity risk. So I should give a bit of background. My last payment from UBS, my last bonus from UBS was in 2022. It has 8-year deferral, so I will continue to receive payments from UBS until March 2030. And the bonus was structured in a way of equity and bonds, and this is to comply with the regulatory agreements of the PRA. And UBS has engaged with the Bank of England through myself to convert that equity, not to accelerate it, but to convert it into very junior bonds, so that they will vest at the same time, but I no longer have any equity exposure. In the run-up to this hearing, and indeed this morning, I sold my very last UBS shares, which I currently own, and I've sold all of my UBS bonds, additional Tier 1 bonds. I've sold, in the run-up to this, all of my single exposures to banks and insurance companies and any bonds that I hold. I do hold some structured bonds which I can't sell, but they are slated to roll off and be no longer invested in financial institutions once that happens. So I've really tried to draw a line in the sand between my past life and this new life.
Thank you. I was also interested to see that you divested yourself of your cryptocurrency holdings. Was that Bitcoin or something else? And tell us about why you were in the cryptocurrency markets.
Okay, well, I didn't have to sell my cryptocurrency holdings. I chose to, having talked about it with the Deputy Secretary of the Bank. Inconsistent with the increased number of discussions around digital assets. I treat them as securities. I think it's an appropriate way to trade them actively, but they are actively traded, if you see what I mean. I did hold Bitcoin and 2 other coins, and the reason I held them was because I didn't like not holding them when they have a whole lot of intrinsic value to them, and it also made me engage with the subject. And there are 2 very distinct things going on here in the crypto world. There is the very speculative store of value world, and then there is actual real technological advancement in settlement across a distributed ledger technology. And you can look at certain coins now, I won't mention them, where there is genuinely very substantial revenue and very substantial revenue growth as these coins do settle transactions across them. And they're two
and should issue its Bitcoin.
Well, I'm not sure. If you, from a private perspective, I would rather be gathering the value of a stable. Private companies take the value of a stable coin because, of course, the stable coin has no yield. To own my coin and I pay them nothing for that, then it's better than having to pay them some interest on a bank account. So there's great value in being the issuer of a stable coin. I recognise there's a lot of work going on behind the scenes at the Bank of England. I'm not familiar with coin issuance by central banks is going to happen.
And thank you very much.
Thank you very much.
Yeah.
John Grady MP.
Yeah, thank you very much, Mr. Soanes. You've had a very long financial services career, and that's the experience you'll bring to bear in this new role. I guess what people might ask is, how will you feel pushing back against the lobbying of your former colleagues?
Yes, it's a good question. I mean, I do not arrive here feeling in any way negative about my former colleagues. I mean, I had a 30-year career, and one of the reasons I had it was I worked with very good people in a terrific firm, and I respect them, and I appreciate their culture very much. And I dealt with clients. So I agree. I come into this with a positive view on the industry and the people who work in the industry across insurance and banking. However, I have in the past been on the other side of the table. I did advise government during the 2008 financial crisis, and I had to sit in a room with the 8 CEOs of the major banks at the time and have it out about what was going to happen and the emergency at hand. And if you do that in the right way, you can have both a respectful but also contentious relationship. And that may well be what happens over the next 3 years from time to time.
You will feel entirely comfortable saying no to your former contacts in the industry?
I won't feel entirely comfortable about it, no. I don't feel entirely comfortable saying no to anybody, really. But it's all about credibility, and I think on the other hand, I could say that when I say no, it might have some great credibility associated with it because I haven't actually really lived their experience.
And what would you like to most achieve as a member of a PRC?
Well, I'm going to start off by trying to gain some credibility on the PRC, because whilst I bring credibility from my investment banking career and as a commercial, on the commercial side, I don't have any credibility in the PRC and at the PRA, and that's going to take me some time. It strikes me that there is a mood shift has gone on. There is going to be question marks about the regulator, and there is an upcoming strategic paper going to be issued, I think, by the government around growth and competitiveness. They're consulting on it now, and that may well set the mood music, and I hope that I can explain to the PRC and the PRA how it can be adapted to help ensure that the regulation is correct and that the as supportive as it can be whilst remaining stable.
And what do you think the PRC can do to improve its operation?
Well, quite a lot's just happened. And you look at the first wave of SCGO changes, the international competitiveness and growth changes, quite a lot's happened. I'll take one example, the matching adjustment. So the matching adjustment, it's a significant change. 10% no longer has to be fixity. So here you can have, you can measure how much use of this 10% insurance companies make. Are we going to be coming back in 2 years' time saying, actually, it can't be 10%, it's got to be 15%, 20%? Be no use of it at all. What have we got that right? Has the insurance industry got it right? Has the government got it right? And the PRA? So some of these changes, you will actually be able to say what has actually happened since we did it. There's quite a lot of work going on around bonus payments or remuneration generally, a reduction in the years that it has to be held, and a removal of the cap, which has happened already. I think that's measurable in terms of what actually happens. How many more senior folk are based here? And is there any change in behaviour? I think it's measurable.
And just in your experience, do you think financial firms can be disingenuous, or shall we say less than helpful to regulators, and in what way?
I think disingenuous is it's not a word I'd like to use. Can regulators be disingenuous to firms to try and get their ends and means as well? I mean, it's a difficult dynamic, and you're trying to sort of get close enough to really understand, but keep the distance to make sure you can make. And this is happening both sides. So, look, I think the culture of firms has changed remarkably, and it's changed, I think, because of the SM and CR. I think the senior manager regime made enormous additional resource become available for the governance of firms. It's very much a UK-specific thing, and we can talk about the various complexities around it. Consequently, I haven't seen this disingenuousness that you mention. Is everyone always honest all the time? No, they're not. The industry and the regulator and all of you folk in this room here, we're all part of the human race, and there's always going to be a few people in there who aren't telling the truth. And we have to be wary of that. That's why we have operational risk capital.
Thank you. Thank you very much, Mr. Grady. Mr. John Glenn, MP.
Thank you, Chair. Can I turn your attention to growth versus regulation? It's the sort of area where there's a lot of focus at the moment. Obviously, the financial services sector is a massive part of our GDP in the UK. And obviously, we have the legacy of going back to the previous crisis. And I think the view could be that we put in place some pretty strong guardrails following that, but we now need to look at whether those are fit for purpose in the world that we live in now. And you just described the changes to the matching adjustment consequential of the Solvency II changes. Do you think that there are other areas that we should actually have a conversation about between Parliament and regulator and industry around what could change and should change in the context of the distance from the last crisis and whether they're still live or not, or should be live?
Yes, so look, I think it's perfectly reasonable that the last crisis led to this very great surge in regulation. It's entirely expected. And I would say this, firms benefited greatly from that. The credibility that firms got from the enforced regulation helped them recover their reputations for being a place you could put your money, be insured by, whatever else. So there is a great deal of commercial benefit from being able to say, we're regulated by the PRA, the FCA, and we have to do this. We have to be strong. We have to have these rules. And we rely upon that. And certainly some firms were more affected than others by the financial crisis, and they particularly benefited from this. So, that aside, it's likely that the thicket has become just that, and that it's really quite difficult to say that every aspect of the financial regulation, the interaction between the MREL, the leverage coverage ratio, the net stable funding ratio, the liquidity coverage ratio, the overarching requirement for equity capital, the makeup of the instruments that make up own funds, etc. Of course, there's a possibility that's all got too intermeshed. But it's more likely that where we're going to be able to make some changes is where we reduce the cost for firms, which means they can make their banking and insurance products more cheaply and therefore sell them more cheaply, is in things like reporting, things which are duplicative, around training. There might be something on the certification regime of SM&CR. It's things like that. I don't really feel that, given the experience of COVID and the war on Ukraine, that there's a great appetite from firms or from the regulator to reduce capital requirements. They are, in having them, they are reducing the cost of the business. The debt cost of these firms has been more stable as a consequence, which is fundamentally what drives the price at which they lend.
So, I recognise that is likely to be the view of all regulators, because they're unlikely to say, well, we've got it wrong over the last 5-10 years and we've been holding competitiveness back. But you have given us constructive perspective on what could change. Could I just probe that a bit further? Could you try and characterise what those changes to reporting, training and some of the other things you mentioned could mean in terms of competitiveness? Because I think people watching will probably be a bit frustrated by this, the letter of the Chancellor, the sort of response of the regulator, trying to be helpful, but how do we quantify this? How do we actually get a sense of how meaningful the changes you mentioned could be and how quickly they could have an effect on growth in this country?
Yes, I mean, the numbers were put into the record in the House of Lords by the CEO of the PRA in January, where he said that the cost to insurers of reducing their reporting by 35% was between 90 and 170 million pounds. That's the cost. I mean, it feels to me like a substantial number to serve against an annual saving of 60 million pounds. So this is part of the problem. If you're sitting there at a firm and the phone rings and it's the regulator saying, good news, we're going to get rid of this, that and the next thing, they're not high-fiving. It's more work, it's more cost, and it's quite a delicate balance. MiFID, when it came in, it cost a firm I know very well over 1 billion Swiss francs. I'm slightly giving the game away. But unwinding that, it's future benefit. So it is a delicate balance. But culturally, collecting data for the sake of data, that can change. Of course, we're having this discussion about data right now, when actually the ability of the regulator to use that data has gone up incredibly.
Yeah. My colleague Dame Harriet Baldwin and I obviously were economic secretaries to the Treasury, and these conversations are probably more familiar to us. And some you were on the City UK Council as well, and we had those conversations previously. But how quickly can we bring in some of these things? And the other thing is, one of the things that I'm wary of is that whenever we have legislation in Parliament, there tends to be amendments, well-meaning amendments, from the opposition party of the time, which will say, well, we must have a regard to this. Thinking it's going to be instrumental in dealing with climate change, for example.
Yeah.
Could you say something about where you feel, as you look at the set of obligations you have in front of you from legislation from Parliament, whether there's any sort of things there that are there in form but not in reality, and that actually give burdens to institutions, and how do you see that? Is that something that can be addressed through some of the call to action that the Chancellor has given you?
I think there are 25 have regards. I've heard it might be 31, and of course they are very well meaning, but if you have for the PRA, every single thing the PRA does, it has to be able to account to every have regard, because the committee through the PRC that we answer to is Parliament. We have to agree. So it is. So actually, rather than make work for the PRA, it might be it's on you to decide which not to have regard to, which is.
Isn't that what's required to free you up? The point is, there's this sort of interplay of well-meaning but contradictory dynamics between Parliament and a regulator, which means we're asking you to do two things at the same time: enable growth whilst also take account of a vast range of additional things.
It's absolutely right, but I'm not sure where else it can land up on. I mean, it's got to be that someone has to be the meat in the sandwich, and it's the PRA and the PRC, because I understand why Parliament, it's a very thorough process, ends up where it ends up. And we have to try and make the most sense of that. Look, I've looked at the have regards. I can't easily tell you which one to remove. I mean, it's just a difficult situation. I mean, it's a very complicated business.
Thank you
very much. Bobby Dean, MP.
Yeah, sticking on the same theme, really. I was struck in your questionnaire response. There's a line that said the consequences of the financial crisis of 2008 are still fresh in the memory. At least they should be. And in your conversation with Mr. John Glenn there as well, I kind of get this sense that there isn't a major opportunity for growth from regulatory changes. There's definitely regulatory changes that sound like they need to happen to kind of tidy up the thicket, as you described it, that's emerged over the years, and we can do some simplification here, and that might reduce some cost of business. But are there really major growth opportunities in regulatory reform for the real economy?
Well, first of all, there's only less than 10% of MPs were sitting in 2008. The chair's one of them, and another member of this committee who's not here today is another one. So I'm not saying that means that Parliament is not aware of what happened in the financial crisis. Clearly they are. But the financial crisis is still today's business for people who were in it. The appearance on banking balance sheets of assets that they couldn't value and therefore led to a loss of confidence is a constant thing to battle against. So that's the first point. In terms of moving forward, I think that a little bit more time since the last major threat, which was COVID, and then it was the Ukraine war, is justified. I mean, I think it's more justifiable to think that what happened is still very recent, rather than thinking it's in the past, if you see what I mean. And that's how the PRA might feel. I mean, I haven't asked them about it.
to just go to your first point, I was 18 in 2008, so I've actually lived with it my whole adult life, so I think it's quite present in my mind. Sorry. I know, I've annoyed a lot of members of the committee, but I have to say, but it means it shaped my entire adult experience, actually. So I guess the point I want to get at is that there's obviously this massive scramble for growth from this government. They really want to make it happen. And we talked about earlier how there are some ways that you can achieve growth that might only be growth for the short term but result in long-term instability. Are you fearful of any downward pressure from this government on that point, that there might be, in this rush for growth, some measures pushed that could undermine the long-term stability of the economy?
In my evidence, which you've read, I deliberately did not include growth when I talked about the standoff between Prudential standards. Because there's not a standoff between Prudential standards and growth. You cannot have growth without stability. End of story. Equally, you need growth to build firms' resilience, build their profits, and allow them to be active members of the economy. Competitiveness is a different matter. You can make very different rules to make your economy more, you make your banking system, your insurance system more competitive. Changes to the SPV rules which are coming on the insurance side, that's going to make it more competitive. The risk margin changes in terms of the amount of capital firms have to hold in the event of a transfer. These things are going to help competitiveness. And as we've talked about before, there's some rules around securitizations and the deductions required by insurance companies to hold them. All of these things are actually going to help our competitiveness. But it's also going to increase the risk. And that's a trade-off. Is there a risk that the government's pushing on this is going to lead to bad decisions? Look, I think, as the Chair's op-ed said, the debate's live, I think, and I expect there will be pressure to look again and look again and look again, and we'll have to keep answering that question. And, if economic growth starts to go, people might move on from that discussion. My instinct is that the lever of regulation on banks and insurance is not the place where entrepreneurship and ideas and passion and all the energy required it starts. It can stifle it if you're not an engaged regulator and you're not trying to be helpful. And I think the concierge news and this new startup business ideas on the banks and insurance side, that all helps. Culturally, when you go into the PRA, who do you meet? Do you meet someone who's trying not to help you, or are you meeting someone who's trying to help you? I think it's the latter.
Thank you very much indeed. Dr. Jeevan-Sandharan.
Thank you, Chair. You spoke a bit about the ways in which you need regulation for growth. You spoke a bit about risks and about climate as well. I want to pick up on some of that. In your answer to the questionnaire, you make the point about the systemic risks that climate faces. Specifically, you say the risk to financial stability from climate change is of an abrupt repricing when the future value of a given sector changes across banking and insurance industries. Can you please elaborate on that point?
Mr. Soanes.
Yes. So suppose nuclear fusion comes into being. I mean, it would be great, but it would have very severe consequences in a large part of the carbon energy market. The carbon energy market banks are exposed to across the world, and of course our insurers and our asset managers are as well. So obviously no one actually thinks nuclear fusion is going to happen anytime soon, but the work on the green transition is going to lead to developments in either carbon capture, which will be positive for carbon industries, or it's going to lead to something else which is going to be negative for carbon industries. And these are very substantial elements of the banking solvency and the insurance solvency that we have. So if you change their present value substantially, you're going to have an issue to deal with. Now, so far, if you look at the regulatory process that the PRA is running, they've done stress tests, etc., on climate. They haven't yet put in climate-specific capital requirements for these sectors. And it's just being talked about, and it seems to me it's not going to happen anytime soon. So I'm trying to give you a specific answer to something like that. I'm thinking of other abrupt repricings. I mean, clearly there has been a slow repricing of the ability to provide flood reinsurance or flood insurance. And many folk today cannot insure their homes at a reasonable price. And you're going to reach a situation where people decide not to insure, which is collectively very bad as well. It's individually, it might make sense. Collectively, it's very troubling. So how do you fill that gap? Because that's not an abrupt repricing, actually, but it's a substantial change to the way that we value millions of homes in this country. And you can value a home in many ways. One way is to say, can I insure it? Because if you can't insure it, you cannot lend against it. If you can't lend against it, it's fundamentally worth less.
So on that, are you worried about stranded assets then in the financial sector from the climate risk that is not currently being adequately priced, as in a future price change?
Well, maybe I'm being too optimistic about this country, but in terms of, we've had some devastating floods here, but there has also been an increase in flood defence. But in the event that the climate change carries on in a way that does lead to a level of sea levels which leads to substantial parts of, say, the River Thames becoming uninsurable, then yeah, that's going to be a substantial change. And that is not captured anywhere. Though it is in a way, because a lot of these houses have very old mortgages against them. A lot of houses do. And actually those mortgages probably have a disproportionate level of capital against them versus the risk they offer.
So then thinking about that, my final question about the PRA and its role, maybe your role going forward, how do you think the PRA should change your supervisory expectations to account for these risks, these changes, the climate transition that's coming before us?
I don't think they should change them. I wrote in my answer that they've notably increased focus and pressure. They are supervisory expectations. I think they've brought as much focus to it as they possibly can. If they brought any more, they'd probably be subject to the opposite charge, which is they're sort of, overdoing it. But it's the law in this country that by 2050, things have changed. And so the regulator has regard to that. and that's part of it. But I'm not arriving on the committee thinking it's underweight on this subject.
Thank you very much, Mr. Soanes. Thank you
very
Chair.
much, Dr. Sander. John Grady MP.
Yeah, Mr. Soanes, you used a very interesting phrase a wee while ago, which is it's a very complicated business. Against that background, what are the 2 or 3 things you believe you and other members of the PRC should be really worried about over the next 10 years?
So, is this also the same question as what would keep me awake at night? Or is that later?
Variation.
Yeah.
But you might be a good sleeper.
Yes. Look, I think there's 2 major risks. The first is the risk-free rate, which is effectively the rate that governments borrow at, and the requirement of governments to continue to borrow substantially. If you start to push up the cost of capital because the risk-free rate's going up, that's a chilling effect on economic growth. Now, in certain countries, there's a fiscal framework which is designed to prevent that happening. In other countries who've just been going through an economic expansion, they're still running a 6% deficit GDP, which is it's at the wrong point in that cycle. So risk-free rate is number one. That's fundamental. The second thing is just the simple point of assets which arrive on banking balance sheets which aren't well understood and aren't immediately liquefiable. And in the crisis of 08, it was CDO squared, CDO cubed. It became this asset that was so complicated it couldn't be valued. Banks lost confidence in each other, and we saw what happened. How could that be coming this time? Well, banks are lending substantially to private credit. The private credit exposures, if they're direct, it's one thing, but if they become the sort of the AA tranche of a securitized CLO on the back of a whole bunch of private lending, then that asset can become quite complicated. In fact, it is a complicated asset. And if that appears too too great a rate on a bank balance sheet, I'd be worried about that. The PRA has already made steps to stop that happening. And you can make a similar case in the funded reinsurance market, where effectively you're changing insurance risk into a credit risk, and that credit risk is being taken in a bunch of assets, some of which are structured.
And just on the first chapter of your answer, on the risk-free rate, is your real concern that there are various Western economies that are heavily indebted and the cost of borrowing will go up and that will feed through to the rest of the economy?
Yes, because the population is ageing. So you've got two things are happening there. You've got higher costs of social care, and you've got lower productive economy in the younger years.
We call for fiscal caution on the part of Western governments.
I'm not making absolutely no comment on the fiscal situation, but it's something to be aware of as a banking regulator, that the fundamental building block on which all banks and insurance companies are valued is the risk-free rate. I mean, that's money.
Yeah.
Thank you very much,
Meg.
Ms. Greeley. Rachel Blake MP.
Thank you, Chair. You talked about how changes in remuneration and the removal of the cap were measurable in terms of behaviour. Can you elaborate on how you can measure those and what you're seeing in terms of those behaviour changes?
I did say that. What I was trying to say was that by removing the bonus cap and removing the term by which bankers get their bonuses, and some other executives too, you can measure how many people are attracted to the country who otherwise wouldn't have come. Are we seeing an expansion after many years of stagnation at best, probably shrinkage? And I think that's going to be measurable. To say that I can measure the lack of cultural change caused by changes in the bonus, I think I've gone too far if that's what I said. I wasn't trying to say that.
Okay. You said it will be measurable. Can you give us any
what's measurable is the number of people arriving here, and the number of people, therefore, arriving here who are willing to be subject to the senior manager regime and the certification regime. So I'm talking about that. That's what I would be measuring. The ability of those people to follow the senior manager regime, I suppose you could measure that through how many enforcements the PRA or the FCA is forced into. That is measurable. But I wasn't really trying to make that point. I was trying to make the point about we're trying to make the international competitiveness of our very large financial sector even more competitive. It should result in more people wanting to work here, be employed here, pay taxes here.
So is there a way in which you can measure improvements in the culture of firms?
Yes, you can measure improvements in the culture of firms. On the one hand, you can measure it simply how compliant are people being. So every firm has a large training program, very substantial. How are people doing it? Are they doing it quickly? Are they taking time over it? You can measure all of this. How many personal account dealing infractions are there? How many times is the regulator notified of bad behaviour? It's measurable, and you can see it. And I reckon it's been pretty constant, actually. So it's not getting worse, is another way of saying it. So I suppose, in the event that we do attract substantially more bankers back here, it's bankers we're really talking about here in terms of the senior manager, the changes to the comp, we will better see if those numbers go up. Measuring culture is as Andrea said, it's difficult because you are constraining that culture by the rules themselves. I mean, all of the drivers on the road in financial services are not driving above 70 miles an hour because they can't. You take away those restrictions, we don't know.
Thank you. UN Yang MP.
Thank you, Chair. Ms. Soanes, you have said in your questionnaire that you don't intend to give public speeches other than, of course, as part of your school's outreach work. Could you explain your decision not to give speeches and also speak a bit more about how to improve transparency when it comes to knowing how well the PRC is doing?
Well, I'm not going to give speeches because I think I can't say anything interesting. Because everything that is held at the PRC is just too confidential to talk about, and therefore my speech would be limited to very high-level architecture functioning, if you like. And I like giving speeches, so it's not something I don't do because I don't want to do it. But I accept the question, and the whole point of the question is that the PRC is not transparent. And I haven't checked this answer with anybody, so it might be the wrong one. But
you've been appointed now by the Chancellor.
Well, yes. You see, it strikes me that there's a parallel here, isn't there, between what's just happened at the FCA and the discussion about naming and shaming. If we were to publish our minutes and have more transparency, we'd be in the same debate with you. So we haven't gone near that debate so far, and I certainly won't be pushing for that.
Well, part of the transparency is that you're here in front of us with Mr. Enria.
Yeah, that's exactly right, and I'll come back.
Oh, well, there was an offer.
Only if you ask me.
Not sure. You should see the reactions from the people behind you. No, I kid you. Ms. Young, anything else? No, okay, thank you. John Glenn, MP.
Yes, could I turn to the relationship between the non-bank sector and the risks to PRA-regulated firms? In your last answer, you focused on this. I suppose it leaves quite a few things hanging in terms of how this might play out, and therefore what proactively the PRC might do to get to a better place in this. Could you say something about what you think would be a reasonable way forward, given the explosion in the growth of the non-bank sector and the way that they're not regulated?
Yeah, so I think something like half of the credit creation since 2010 has been in non-bank credit creation, which is market-based finance. So it's a very substantial sector.
So do you want to say, for the benefit of those watching, what that looks like and give some examples?
Well, it's firms who are not banks. They're not taking deposits to create the resources on which they can lend. They're borrowing money in the financial markets, often collateralized against the very assets that they're going to create. And there's a bit of a chicken and egg there, but effectively they don't have banking capital in the event that things go wrong, and they maybe don't need banking capital because the people who've invested in them are effectively wearing the risks of the assets that are being bought by these. So
we're talking about direct lending, mezzanine funds, private debt funds, crowdfunding, hedge funds, peer-to-peer lending.
Yes, I wouldn't include hedge funds in that.
Right.
I wouldn't include, but
all of the others.
Yeah, vast majority of the others, I'd agree with that. Yes, and they played a very important role in providing credit to people who otherwise wouldn't get credit. And if you look at the market for credit spreads right now, credit spreads are trading extremely tight. So there's an extremely tight market for credit products, which you'd expect given the amount of liquidity in the markets, which is still the hangover from the emergency supply of liquidity that central banks had to provide. So if you have a situation where lots of credit funds are looking for opportunities, they're going to do two things. They're going to expand their horizon. They're going to make their products a little bit longer, a little bit less liquid, a little bit more structured, and they're going to make it cheaper. And that's what's happening. Now, it might be that this can carry on perfectly well, but if there is a higher rate of interest than people are expecting, a slower level of economic growth, some of that lending will go bad. When that lending goes bad, it can stay outside the banking system and the insurance system if it is not in those systems. And it is in those systems to a certain degree. And so far, the PRA, in what it's done around funded reinsurance, it's absolutely changed the speed with which that was happening. That's a direct result of concerns about credit, not necessarily just private credit. And in terms of what they're doing around limiting individual exposures to private credit, that too on the banking side is a direct response to that. That might stop it. In the US, the FDIC inquired about its various banks, and you get some big numbers coming out of it, $1.2 trillion of lending to private equity and credit. But the equity is not for equity, it's for portfolio companies and sometimes the equity manager themselves.
In your answer, I think you say, that as liquidity is withdrawn from the market, as central banks start to reduce. No, sorry, not that one. Sorry, where you say when liquidity is withdrawn, the quality of this lending and privately issued currencies will be revealed. That sounds quite sort of, well, we'll see what will happen. So those reading that or hearing that, they will think, well, what more should the PRA be looking at to proactively avoid the eventuality that is in a bad state, leaving your regulated firms in a precarious position?
Fair enough. So that's a global comment, really, which isn't necessarily that useful to this questionnaire. And I was trying to make the point that there has to be consequences for all the additional liquidity we've seen in the market. And those consequences are the price we're paying for solving the emergency in the first place.
Yeah.
And I don't yet know what they are. Now, what can the PRA do about it? It can do what it has done: limit exposure to private credit, limit exposure in the insurance sector too. It has done that. So it's nervous of that. The private issue currencies, I'm clearly talking about the sort of 2.5 trillion crypto market. The impact on the banking sector and the insurance sector from that in this country is very, very limited.
Great. Thanks very much.
Thank you. And finally, you've been a very busy banker for a very long time, and now you are the vice chair of a parish council, member of the Deanery Synod, trustee of the Clement James Centre, and advisor to the Clement James Centre, and on the development board of Duchenne UK. So you've got other things going on. Do you have any other ambitions to take on any other roles as well as the PRC?
No, I don't. It's going to be my only role. Okay.
So you don't think you're going to get bored after a very busy career?
No, I'm not. I mean, 2 days a week is going to be really a lot. I mean, hopefully I'll do 3 or 4, but it's paid for 2.
Well, there we go. That's a good way of winning over a committee that's looking at how taxpayers' money is spent. Can I thank you very much indeed, Mr. Soanes. Thank our colleagues at Hansard for recording this, and our colleagues at Bowtie for the broadcasting. We will then go into private session in a moment to deliberate on our comments on the 2 candidates who've been appointed to the Prudential Regulation Committee. Thank you very much indeed. Order.